What's up, guys? I think Global Flows has an audio issue right now. So, good morning. Good morning. We're going to be a little bit more locked into chat today. So, if you guys have any questions, thoughts on the week, anything you're personally recapping, I think it might be a good idea to go ahead and type that in the comments, and we'll try to get to it if it's somewhat reasonable. If it's reasonable, or it's a really, really well dialed in troll. Otherwise, if it's anywhere in between, nah, you ain't gonna get it. Can you hear me? Guys, give me a if you hear me at least, give me a thumbs up in the chat. All right. And shout out to the golden cat in the background. This is how you train for festival season, if that's your thing. All right, so it looks like you guys could hear me. I guess I'll pull up my chart until he gets back. Let's see here. We're working through it here. It's Friday. We're working through it. No, I can't. It's not my stream. I can't pull it up. I tell you what, that is some serious reps for the cat. That dude is keep it. He stays strong. By the way, I started the peptide game. So if you guys, I don't know if any of you guys out there are starting it. Let me know if you are.
Am I coming in now, James?
Yeah, he's so back. I was gonna try and share my charts while you were gone, but you have to actually present them. So it's just me. Just me.
Am I clear enough right now? My regular microphone isn't working, but I'm just using my laptop.
Yeah, it sounds great. Actually, it eerily sounds better than usual. So.
Oh, well, there you go. All right. Well, everyone, thank you for joining the Capital Flows live stream. Just going to pull up the chart and comments. All right, everyone, thank you. If you guys are on Twitter watching this or wherever you're watching this, please reshare it. And then if you guys have questions, put them in the comments section. If you guys have anything that you want to talk about, throw them in the comment section as well. There's the main focus of today is one, covering the price action and market, and also to talk about a lot of the ideas that, we've been laying out over the last week, a lot of the ideas that I've been covering, things that James has talked about. And so I think it's going to be very helpful if you feel like you've been a little disoriented and you're saying, I'm trying to get the context about where we are, and I'm trying to get a little bit deeper into why things are taking place. This is going to be the perfect stream for you. And so, again, if you're not already a subscriber on Capital Flows Research, everything is laid out there at capitalflowsresearch.com. We had some pretty, honestly, banger slide decks this past week and ideas that we've gone through that I think have been really helpful, especially on the Warsh side. I mean, I think that was just the highlight of this past week because, coming into this week, everyone was basically thinking, what in the world does Kevin Warsh think? We don't even know what he thinks. We have all these interviews of him years and years ago, but we don't even know what he thinks right now. And so I think that happening and, providing a bit more clarity to market, and then that's really going to reorient the framework we have for everything. So again, if you are, brand new, come to capitalflowsresearch.com and scroll down, go to decoding the Warsh testimony, and go through this and go through the entire slide deck here. I mean, spend time going through this slide deck right here, because I just think this is going to be one of the most important things that you can spend time doing over the weekend and thinking about these comments, going through the recording of the live stream, things like that. So I think that's going to be one of the main things. And then on top of that, we had coming into this week, James, you can kind of expand on this a little bit more. We had this entire question of, we just rallied a bunch, and everyone is saying, okay, well, we should basically chop in a range here now because we're overbought, quote unquote, overbought, right? And people are gonna be a little cute. And this is why knowing where we're at in the credit cycle is so key, because it tells you where are we in that distribution of is a melt up likely, or should we be less aggressive, right? So there's, I think, a lot of factors like that that we kind of came into at the beginning of this week.
I like that. By the way, oil, if you want to pull up CL1, just spiked down. Hey guys, in the end, also, we are still traders. We are watching this shit. So I think it's a really cool, one of the things we've been talking about recently, and we'll get back to exactly what you're on, Flows, but I don't want people to forget that we're actually like practitioners too. We are trading. I am trading futures in oil. I'm watching this as we go through this stuff. So if you guys want to talk about like, actual stuff happening in the markets right now, we are able to dive into that as well. It's not just the broader picture, but I think that's what we're trying to pull together for you guys is like, how could you take the fundamental price of money globally and work it down into like actual actionable trades? And I think that's great. So yeah, what are your thoughts on that whole, like, let's take that S&P thing. Like, when you see a chart like that, what runs through your head? Like, when you see that kind of
the S&P chart,
like when you see that kind of like violent reversal, break of all-time highs, and just sitting up there, like, what does that instinctually make you think? Like, let's say you had no position, right? Like, what are your first thoughts on that?
Instinctually, when I see something like this, where we gap down at the open, and then when you basically flush this in a illiquid session after future, or I think it was overnight session, and then we just retrace it and bid, all of that. And also, especially on the Nikkei, if you're watching the Nikkei overnight, I was talking about it in the chat overnight, and also looking at Nikkei tech, and then TSMC. Those are, which is just bidding now. Those are all signals to me that we are going to move higher. And you have the NASDAQ leading the way. The Russell is lagging a little bit, but I think the Russell is going to hold. And like these gap levels keep getting filled, right? You keep having, and this is where understanding the underlying rotation takes place, right? Because you have ES right here, and we're in this bit of a range. And so what I want to do is saying, okay, if we have a move up right here, is this the breakout? Is this the breakout? Is this the breakout? Is this the breakout? Are we going to just keep on chopping right here? And the way that I work through that, especially from a trading perspective and thinking through, okay, should I be buying breakouts or fading them or taking gains at them? All that comes back down to the underlying rotations that are taking place. So for example, I laid all this out for paid subscribers earlier, but you can see XLK is broken down into two sectors, basically, software and hardware. So XLK overall is bidding. And also, I talked about this yesterday in the live stream. We're up, 17%, 22% from the lows. Yeah, not a short squeeze, guys. The entire tech sector doesn't rally 22% because some hedge funds are adjusting their positioning. That doesn't happen. So you have XLK, but underneath XLK, these aren't going to be perfect representations, but basically you have hardware, which is all the semi stocks, which you have Intel in there, Nvidia, and all of these names. AMD, which is also up on the day, INTC, Intel, also gapping up on the day. But the other side of that is the software sector. And this is why I'm so bullish right now, is because you can notice right here on the day, software is down a bit. Oh, it's actually up a little bit, but down from this high right here. When you have software down like this and tech up, that just shows me that you have equity long short positioning that is long semis and short software, which makes sense because you can see this going down right here and then semis pumping. And then when semis go down a little bit, you have software moving up. This is just people putting on and taking off pair trades when you have these shocks to the market. And then you can see right here, notice that you've kind of moved down in software at these lows when we bid in semis. This is just very basic equity long short positioning. That's long semis, short software, so that they're market neutral. And then on the day here, you can see this stronger move. You know, when vol expands on these moves, that's when positioning, long short positioning, really readjusts the most, because they have to always readjust their longs and shorts so they're sized correctly against each other. Now you have, you know, software is down just a little bit on this move up from this high right here, but the entire setup in the equity market right now is that if software bids right here and squeezes out all of this positioning that we've had for months and months and months, which is why I'm long Oracle right now. If that takes place, you're going to have a massive contributing factor to tech, because half of the entire technology sector has basically been in a bear market. And so this relationship is one of the most important things I'm watching right now for tech. And that's why, and tech is 35% weighting in the index, in the S&P, even larger. And then especially all this Mag 7 stuff, because Microsoft is actually part of the IGV sector. So if you look at IGV, which is the software sector, one of the major names in that is Microsoft, which is also where are we at? Microsoft, which is also what's up? It is obviously one of the Mag 7 stocks in the index. So you can see this moving in lockstep, Microsoft and the software sector, right? But now we're seeing Microsoft beginning to bid. Everyone is kind of realizing that Microsoft is kind of a steal down here when you're buying it. I mean, this just looks like a perfect chart to bid. And you're going to have sector flows move it the most as well. So, you know, when you have Microsoft setting up like this and already leading the way because it has index flows, and then on top of that, you have other stocks like Palantir also kind of holding these lows, and then the position I've talked about the most, Oracle, which I think is the most mispriced. You have and then you have stuff like CrowdStrike, which is also kind of holding these levels. Again, cybersecurity stocks probably not going anywhere. Same with Palo Alto, also probably moving up. So you have all these different names that are setting up, and that's why we also have things like GameStop. I think this goes back to kind of this entire meme stock section we're moving into. I think GameStop and AMC and some of these other names are going to kind of start to bid more aggressively, and I think it'll be expressed in certain new names in the meme stock place. But when I look through the price action today, when I look through the price action today and I see equities up, and then I see bonds holding their levels. If bonds are holding their levels, this is like perfect. And so this is going to be very interesting to see how it plays out. But those are all the signals I'm watching right now.
Yeah, just to add on to that GameStop idea while you're adding it right now, I think what a lot of people forget, and this is where maybe my sauce comes in a little bit, is the stored up clout of that trade. All right, GME has not been forgotten by the general public. Crypto has been forgotten because it's a repetitive beatdown, right? GME was like this flash in the pan in 2021, and then a flash in the pan Roaring Kitty situation if you scroll back a little bit when it popped to 60, right? But there's this stored up like love for GME that still exists. Now, the kicker is, right? Roaring Kitty has been gone for a long time. I swear to you, I already tweeted about this, that if we break out of this range and go up like $10 or something at GME and everything starts to turn on, I'm 98% sure Roaring Kitty's coming back. And that he has a plan. Just like, do you remember what happened last time? He came back and he started posting all those meme videos. Do you remember that? It was like an automated, like every couple hours, he was just like posting. And then after like this options craziness, he kind of disappeared again. But this time, you not only have the retail, like if everything bids and people are like the wealth effect is strong and euphoria starts to come back, the GME meme factor is stored up and ready to go. And if Roaring Kitty comes back, that's one thing. But I think the even bigger one that's hilarious is the Michael Burry one, right? The fact that the biggest fucking bear in the world, known for just thinking the world's always basically overvalued and going to end or whatever, is balls long GME and added to his position this week, I think twice. Right. So imagine the online clout and articles and stuff that could be like Michael Burry is long GME, breakout, Roy Kitty's back. The Big Short guy is now long GameStop. Like, I just see that creating an absolute fury. And we're sitting down here on the precipice of a breakout of a euphoric run that nobody's talking about. Nobody thinks we could have another 2021 style at least push for a month or two. I don't hear many people talking about that. So when I think about the potential of something, now, is this my base case? I don't know. Maybe, maybe not, whatever. But if you haven't at least thought about the possibility of that, you're never going to pull the trigger on like a nice options, like a call option play when volatility and positioning is like here, right? Because it doesn't feel good. You're going to wait until the breakout, till volatility expands, till your buddy's talking about it. Then maybe you pull the trigger. Well, you just took so much asymmetry out of that opportunity for you, right?
Yeah.
And we're looking to position into things that we think are going to have good potential to happen before anybody's actually taking the positions themselves. Because like the biggest fund managers in the world, the Bessons back in the day, the Duquesne, the Paul, they're trying to position into the things before the other people are, so that they can be the ones who hit the home runs, right? They're not looking to like piggyback off the back of some other people. They want to be the pig. So I don't know. I just find that one super interesting, and I'm not some GameStop dude. It's not. When's the last time I mentioned GameStop to you before like a month or two ago or whatever, right? There's some people I know that perpetually live in the GameStop or aura or whatever, but I don't know. This one's just looking really interesting.
Yeah, well, and especially when I think about trading situations like this just goes back to betting on tails, right? Like you and I know, I think this is one of the things that we've talked about a lot is I know that, and this is where understanding how to trade things is totally different than financial content. Because when I see this chart right here, I know that there's two different scenarios, right? Or I guess there's a couple of scenarios, but let me just talk about two. We could just keep shopping right here. Or, from here, you could begin to move up. Now, what I think about in this scenario is, okay, if we're going to do this, and then like, let's say we move up right here, how do I size my position and recognize how many times do I need to run this trade to make money? Because let's say this is a 10-to-1 payout, right? Let's just kind of keep it simple and say it's 10-to-1 payout. If this is a 10-to-1 payout, how many times can I buy, or maybe buy a little bit more with a longer expiration, right? How many times can I buy and be wrong so I'll still make money on a 10-to-1 payout? And that's really key, because a lot of people are going to think about this is it happening or not in a binary sense? Whereas if you are actively trading these markets, you know that you're always adding in a margin for error so that you can be able to stack that, right? And I think that's especially, key. We talk about order book stuff a lot and a lot of little edges. And, you're usually trying to spend, you and I always talk about this. We're just trying to get on sides, because if you get on sides, then you get a winner. And that's when you can press your edge. But until then, you're always just trying to get on sides or bat singles. And I think that's again, something that's not talked about as much, because it goes back to, you really need to think about, well, what is this from the perspective of someone who's actually taking risk and trading in markets? Because you know, you and I are always trying to figure out how do we set things up so we can just be, you know, right and make a massive payout, right?
Yes, and you know, we were talking a little bit earlier about how when you risk doing this, you're there is potential where you're going to be sitting in these trades while other things are moving, right? I mean, what happened with semiconductors or like Intel
Yeah.
yesterday? I sent you a screenshot that I saw from somebody who crushed the Intel trade through, and I was just like, you can't help but make it feel like, oh, like it was so obvious. It was the Trump trade, it was the America trade, it was all of it wrapped up like of course. But you know, there's a musical chairs in markets too. And are you going to get distracted now? Are you going to go chase Intel when you know you're sitting in something that you have conviction in? And that's a little tricky too, especially today when like everything's moving like crazy.
Totally. I think it's, I mean, this goes back to not getting triggered by social media because, you know, I've had, you know, my largest bets right now are per and orb. And I've had people you know, especially when you have, you know, semis pop off, people will say like, wow, like, you know, I can't believe you didn't buy semis. I can't believe you didn't do this or that. Right. And one, why didn't you tell me that 2 weeks ago so I could get pre-positioned into it? You know what I mean? Like it's just one, that. And two, you know, think about where we are from here, right? Like how should you think about the risk reward? How does it connect to a time horizon and things like that? And you know, this goes back to my, you know, aligning the macro environment with a view that you have. And I think that the fact that we have this situation, which, you know, I've been laying out, if you go back to the live streams I've been doing and the videos, my view is that equities broadly are going to move higher. We're going to have stocks outperform bonds. We're going to have the dollar fall. And, you know, we're seeing, you know, rates basically remain in their range. Bonds are kind of, you know, we're seeing the curve steepen today, actually. And, you know, ZT bid up a little bit. But the fact that this is happening is why the dollar is falling on the day. And, you know, my view is that we're going to move up in the euro here, move up in the pound, and hold these levels because that's the environment we're in, where you have the U.S. putting in more liquidity, especially the peso. I mean, EEW, the ETF, is going to be massive. Just wait until crude actually dumps down on an actual move. And this is, I still don't know why people are so aggressively doing this. But when we were here, you can go back into the live stream I did. I published a video on this. It was April 9th, I believe. Go to the April 9th live stream. We saw basically after this move down right here at these lows, call skew ticked up. So basically this moved down and everyone right here bought the dip really aggressively. And then we bid up a little bit and then we just totally dumped all this positioning. And now we're in this next point where, you know, people are probably getting pre-positioned into the weekend. There's some news moving it around. And my view is that if we have crude dumped down right here, what do you think is going to happen to the dollar, to gold and silver, which again, you know, for a while now, since we were at these lows, and you can go back in the chat and see, I've been bullish gold and silver, and, you know, we're chopping in a range here. A lot of people are shorting gold and silver right here because they think they're getting long crude and short gold and silver, which if you're watching this, I mean, just check out, you can see the positioning in the chart right now. Let me show you. I mean, just notice how, you know, right here where you have, I mean, gold and silver were kind of moving in an inverse relationship already. But notice right here, you have gold sell off a little bit on the crude bid. And then notice, you know, you have crude bid a little bit. We're kind of flat right here. And then notice when crude is at these lows, gold bids. And these extremes show the long short positioning and the overall position that's taking place. And then you have, you know, crude bid up a little bit right here and gold is selling off. So that tells you how gold has a sensitivity to the geopolitical risk premium in markets. However, you will notice that like the fact that you have crude bidding right here, but then you are not having that drag on equities, that means what? That means that the entire geopolitical risk premium is not showing a beta to markets. It's not showing sensitivity because you have, semis basically were in this range, sold off a little bit. And then on these spikes that we had take place, you can see right here, crude sells off, this bids it. Then notice when you have crude bid a little bit, it doesn't do anything to semis. And then you have, crude move up a little bit. What does it do? Nothing to semis. It just keeps bidding. So that shows that semis don't care about these crude prices, which just tells me that if crude actually went down, but it's kind of one-sided in my view right now, which is why I'm still bullish equities. And even if you have this other geopolitical spike where crude spikes up again to these highs, it would be, for me, immediately looking to short crude and get long equities again and just add a ton of size, like very fast. So I think that's kind of how I'm thinking about that side of positioning right now.
Let's see here. I'm trying to read through some of these comments here.
Yeah, I wanted to go through on the.
I do have a question for you.
This is
the vests.
never,
dude, vests
ever happening. Ever.
I don't know. Vests are kind of cool, man. I'm a vest guy.
Not Patagonia. I don't mind if it's like a Italian.
Yeah, it's gotta be unique. Yeah.
Or some type of like custom made vest or something like that. But it's like Patagonia vest. Like you might as well just start a LinkedIn profile and start messaging people about like Excel consulting. Like, hey, I can consult you in Excel. It's just like, so like, what are we talking about? But we'll see. Quick question on this. If you are not on the Substack and gone through these changes, right here, go to the educational primer section, download all of these models right here. If you don't have a Bloomberg, you definitely need to download these models. And the last one right here is the attribution model on Oracle. And there's a question about, can you take that model and meaningfully decompose returns of the index? So yes, you can. You need to know the difference between like a PCA and how an OLS kind of calculation works and the trade-offs for them. So I would just put into Claude Code how the attribution of those parts work, if you should use PCA or an OLS, and how you're calculating residual, and then use a covariance matrix of those to kind of further refine the strength of that. And so if you kind of map those, then you can kind of get a better idea. If that didn't make any sense to you, you just clip what I just said and put it into Claude Code, and everything will make sense. When trading single name equities, how do you structurally think about macro? How to map the DXY rates to see where we are in a macro regime? Checklist, mental models. Also thoughts on trade journal, how to properly journal, not just enter trades and why for it, how to make notes properly when on the learning journey. I'll talk about this a little bit and then I'll throw it over to James. But for trading single name equities, you just need to understand, one, how is it connected to sector flows, factor flows, and broad market flows, right? So you're going to have sector flows have a lot more sensitivity to, if you have, very simply, if you have the material sector, it's going to have more sensitivity to inflation, right? And then if you have the tech sector, right, that's going to have, less sensitivity to changes in inflation on the earnings side, because inflation is not really going to change earnings that much. But you can see, let me make sure, there we go. So here's the chart of, let me just date. Here's a chart of the attribution for every sector. And you can see how, if we just look at the returns, you can see energy is down right now. But then you also have other sectors down, like utilities. And then you also have things like healthcare down, while tech consumer staples, consumer discretionary are up. And then, things like this period of time, consumer discretionary or consumer services and things like that. So you always want to say, and why does that happen? If inflation is rising, it's obviously going to impact some sectors more than others because those sectors are inflation in a sense, right? Like consumer staples, they're grocery stores selling food. Well, if food prices are going up, like those are the stores that are raising the food prices, right? So all of these things are the same thing. They're all connected. They're not like separate things. So it's not like, oh, inflation is impacting this sector more than another. Like, sure, but it's also like that sector is the inflation, right? Like it is the actual thing that's changing and increasing or decreasing prices. So same thing for each sector. So you want to get it to how is it connected to growth and inflation? And then you want to connect it to what's their balance sheet? Because if you have more debt on a balance sheet, it has more sensitivity to interest rates. And then you have all these thematic flows, which goes back to you should be going through Liquidation Nation, which is a great place to go through all of that. So I'd encourage everyone to go to Liquidation Nation and go through all their analytics and go through all the factors. So you can, for example, they have a great chart of all the factors they have here. I don't actually think it pops up in the live stream, but if you click on the long and short position, it'll show you a list of all of them. So that is going to be one of the key things to understand overall. And you want to first get all the moving parts together and then figure out how you can model them and weight them. And then from there, you can decompose that. So that's what I would say. James, thoughts on Trade Journal, especially I write down every single thing. I have like this OneNote file and Word doc and spreadsheet that I keep every single thing that I do. I like keep notes on every single thing that I do. And I then have that as a corpus of knowledge for all my AI agents. So I have that kind of on a technical side. But James, maybe talk about Trade Journal, mental side, like that type of process for you.
Yeah, I mean, I used to journal all the time. Dude, come on. It's been like 12 years. I'm not as diligent about that. One thing I talk about on my channel a decent amount is probably my favorite check-in with myself is like I call it my risk spectrum check-in in the morning, in which like when I sit down in this seat every day, I just do like a bit of a self-scan, right? Like, hey, how's my life? How are my relationships? How are my recent results? How are markets acting right now? How have my last few trades been? You could probably type in there like risk spectrum, maybe that video will pop up. But basically, I run through that every day so that I could give myself like on a spectrum, like, am I risk on or risk off? Like, am I, and I don't mean it like in markets, but like, am I prepared to be in a good headspace with good results, with positive momentum? Everything outside of my trading is kind of pointed in the right direction. My energy feels good. My results recently have been pretty dialed. Well, I'm in a position now to push it. Yeah, there it is at the top there. I'm in a position now to push my edge, to scale up, to lean in, right? To push the boundaries, to cross and find that line that I don't know where it is. But if it's the opposite of that, right? If I haven't, there's a lot of lingering things in my life that are adding stress to me. Maybe my relationship is, I'm in an argument. Maybe the past week has gone poorly and I overtraded. Maybe the markets I'm blaming markets. I think they're manipulated. I'm not in any of the things that are going up. All my positions are underwater. Would you say that you're in a good place to take a lot of risk and push it there? No, that'd probably be a day where you want to dive into the capital flows like primer research. You want to reset. You want to maybe watch something that has nothing to do with markets and kind of cross-pollinate some ideas, talk to some friends, chill on the trade, size down, right? And I don't think enough people do that because especially in these like this prop era, everybody's like, my trades have to be at exact size every single time. R&R, like I use 1% every trade, like whatever. To me, it's all dynamic. It should not be the same thing every time. So I think that's something for you to think about. Like, where are you at right now? Don't worry about where other people are at, and how can you get back to like the risks, the side of the risk spectrum where you have like all of the things in your favor. So that's how I think about like me moving through space, journaling. I'm not necessarily journaling every little trade, but I'm always cognizant of like where I'm at on that spectrum. That helps me a lot. And yeah, you could use Claude right now and say, I want to just code up an app that lives on my desktop, that it's a constant flow of like I'm just spewing my nonsense into there. And then every week or every day or whatever you want, I want you to go through that and try to summarize where I'm at on that spectrum and like have it help you. You know what I mean? Like these tools are available. So if that's something you need, like you got a little trading buddy and you don't need some iPhone app to do that. You just make it yourself for free.
Yeah, and I think another thing is a lot of it depends on your frequency of trades, right? So if you're a person who runs a lot of intraday trades, or is you have to do execution intraday, right? Which is a lot of the place. I don't run as many intraday trades now, but I'm always executing on an intraday basis, right? So I'm always trying to put something on and get on sides or something like that. And, at a certain point, we've talked about this, if you're in a period of time where you're running a lot of trades, you might do round trips or places or, in a product or something like that. You might run 20 trades in a day or 50 trades or 100 or something crazy, right? You can do a lot in a single day. And, that depends on your edge and things like that. Or you might just be adjusting things all day and you don't have the time to say like, oh, well, how do I, should I journal about this adjustment that I did, right? I think a lot of it comes to, well, where are you at in this experience? What's going to be most helpful for you, right? Because what's the element that you're struggling with? And I think for me, especially, I'm trying to think about, if I'm not in a great headspace, I just think, okay, do I need to be executing right now and pulling back? Or do I need to just spend time researching? I'll have days or weeks sometimes where I just go, you know what? I just don't want to run risk right now. I'm going to hold the risk that I have, and I just need to spend time reading and thinking. Yeah. Right. That's, again, something that people aren't going to really tell you because they're always trying to put something in your face to say like, you need to act now. You need to act now. Right. Whereas I think our entire goal is to say, how do we build a base of knowledge, which is why we're doing these live streams every day. How do you spend time as a trader building a foundation of knowledge, not only to make good decisions, but also to put yourself around, I think to put yourself in a place where you're thinking clearly, right? Because even today, we're talking about all of these changes and whatever it might be. I know we'll have fun sometimes and we'll throw the vibes and everything, but if you want to think about things clearly and not, panic buy something or panic sell something or whatever, like you should never be operating out of FOMO. If you are, you kind of need to take a step back and kind of like self-evaluate a little bit, right?
Yeah, and look, you're gonna fall prey to it. And I think like just wait. If we do get a melt up scenario, if you think you're protected from FOMO, good fucking luck because you're gonna feel it. I mean, you remember 2021? Like I mean,
yeah.
It was months of just like, I mean, I was deep in crypto, right? Still am, still whatever, but like I look back and I'm like, wow, like in crypto, you went to bed expecting to wake up richer. That's how crazy it was. And you did. You know what I mean? Some of the like NFTs I was trading and things like that, I can't even fathom that ever happening again in that sector. I was trading some pixelated art by some unknown artist where I'd buy it for 30K and I'd wake up and I'd sell it for 50K. Right. And like that boggles my mind. So that type of stuff was happening for months and months and months to the point where everybody was just like all over, like the FOMO was nuts. The screenshots you were seeing were crazy. And if that happens again, good luck trying to think you're protected from that, especially if it's in single name stocks, which like, if you get single name stocks flying, like, I mean, it's going to be wild. And if you get them on chain too, 24/7, prediction markets are flying, like it's gonna be fun. But I just say like you should go in a little bit more of like a process prepared to feel these things so that when it actually comes, you could check in with yourself and be like, okay, I knew this was coming. How do I how do I best navigate through that? Oh, before I forget, and I'll let you go, guys.
Yep.
If these live streams have been helping, Flows and I have been talking about making this more of a thing, polishing it, whatever. If you enjoy these and you're getting a lot of value and you want us to do more, I think it would be really important, please, to like spread this. And if you could just go on Twitter, go to like Flows' account on Twitter, my account, go to the YouTube page, and just please share it. Just fucking Control V, Control S, copy paste it into your stupid feed and just paste it once, please. And that would be really helpful, I think, to get this going. I think it would be, we don't ask for that too much, so appreciate it.
Yeah, and I think also like provide feedback. Like this is this is one of those things where it's going to get as good as everyone helps us get it, right? Because I know I've been working on stuff for a little while now on all of this AI stuff and AI models I'm building out, and I'm going to have something soon on that. I feel like I've said that for a week or two now, and I'm still working on it. But there's going to be so much amazing stuff in the future, and I think that the really key thing is to be able to align yourself with people who are thinking just being able to have authenticity on a stream, right? Because we're just sharing all the stuff that we're doing every single day. And James and I have talked about this, like all the stuff that we do every day in running risk, running trades, thinking about markets, we have these conversations every single day offline. And the entire goal is how do we just have these conversations with everyone and be able to bring everyone into this and then get feedback from people and hear about what other things that are going to be helpful, because that challenges us and pushes us more as well.
Yeah, and this is a great comment. If you want to pull it up, the most recent one. I think that's something we could think about. We'll talk about that.
This
so
one?
maybe, yeah. I think he's basically saying like, the primers are one thing, but almost having a series of that somehow would be good. So we'll think about that. I think that could be interesting.
Definitely. No, that's helpful feedback. I actually will try to put together some stuff on that idea, because I have all these new tools with AI to like visualize everything.
Yeah, maybe it could be done automated, right? Like maybe it could be an automated series that is like, because people could burn through like Netflix style 10-minute videos, right?
Totally.
But digging into your website and reading through it, there is like a big friction point there, right? So yeah, it's interesting.
James, maybe touch on this a little bit of the kind of connection of like volatility, information edge, sizing in relation to it. How do you think about this question?
Alfie, okay. How do you think about sizing positions based on volatility and informational edge? I've been sizing based on only information. Oh, well, yeah, I guess. I think it's not super straightforward if you don't think in volatility, but I just kind of have in the back of my mind running like, hey, am I looking to get into a position where the volatility hasn't expanded yet? And I actually think it's a great high conviction, sneaky bet. I'm much more willing to size way higher in something like that. Once vol expands and there's a lot more attention on it, I get a little more tentative. I get, it's like take Avis for example, right? I mean, that's the way. Like, by the way, the Avis chart is hilarious now after the last couple days. But like once Avis started running, it's like, all right, I know I'm already a laggard in this whole situation. Vol is expanded like crazy. So how do I want to even approach this? And I now approach it with a 10-foot pole, even if I want to get in there. Like I made some money on the Avis short side, right? Which is like, I look back and I'm like, wow, I don't even know if I should have done that, because the vehicles to trade the short side are just not easy. Like you need borrowing margin. You need to be pretty good. I think you need good knowledge about options, and I don't have that. So I think I got lucky with some okay timing and stuff, but I am very tentative when vol expands. And if you're good at fading vol and can get a good risk reward position on for it, I think that's great. And I think that's why I'm so excited about perps and stuff, because like once they have all of these single name stocks on perp 24/7 with volume and stuff, like that's, oh, I'm going to eat that up. Like I will, like the short side, fading vol, like having my risk reward a lot more defined, like that's going to be my wheelhouse. But right
Yeah.
now, I'm just like very tentative to play the fading of vol unless I have a really good expression of that. So that's how I think about it. I look for stuff that hasn't expanded yet. And usually my biggest mistakes are when I start playing after vol is expanded.
Yeah, I agree. I think that I'm always trying to think about, let's just, I added a thing to the TradingView chart of just a histogram probability distribution. And, this is just historical, so it's independent. It's not dependent, which just means that, we're just looking at over the last whatever period of time, how many up days versus down days are there, and how strong are those. So what I do is I say, okay, well, how many up days and down days have occurred over the last whatever period of time? What's the extreme? And then should I expect what type of range should I expect on a daily and a weekly basis, and how does that connect to my view? Because if you are just if you're getting long, if you think that we're going to move up over the next week and you get long right here and then you put your stops right here, I mean, we can have some pretty significant ranges before moving up higher, right? So you need to say like, okay, well, if I'm going to have a weekly range, maybe I should have like, what's my weekly vol? And maybe I should have my stops here and size a little bit differently, right? And same thing with intraday, right? If are you going at the intraday extremes, or how does that work? And so I think you want to say, what's my vol across multiple time horizons? And then the whole point of an informational edge is about why is that vol occurring, and how do I know when to take a certain trade based within this distribution right here. So if we have an up day or down day on a weekly or whatever basis, do I know why that's taking place because of my view? And so I think that's how I think about it for both of those. Another question here, I think this would be good for you, James, is I would appreciate it if you could give me about I've been trading for about 3 years, feel like I'm getting better, but I'm losing money. My edge is fragile. Could give me some tips on what to do. I'm intraday trading equities. I don't have a strategy. I try to observe the market and react to when there is an edge to extract. I overtrade and I over leverage 50% of the time. Thank you for the help. I appreciate the honest comment, man. James, maybe expand on this and some of the videos that you've made recently and talk a little bit about that.
Yeah, for sure. Can you hear me? I feel like my thing is lagging a little bit. I have a
Great.
lot of stuff running. Okay.
No, you're good.
Well, all right, so you're being honest, so I'll try to be honest here. It sounds like you're just in markets with no plan, right? Like it seems like you're a little bit like, hey, I'm going to let the market dictate how I approach things. And while there's some like freedom in that, I just feel as if you're always going to be reacting to what is happening to you. And because of that, like you're always going to be a step behind. And like there's just no way, you don't have a framework to attack markets with. You're not bringing your process to the markets, right? So I think that's what, like, hey, if it starts to not work out, you're reactive, you start to get a little emotional, you start to overtrade, you're using leverage. Like you just said, I don't have a strategy and I try to observe and react. That right there should be a sentence you don't type, right? So I think you need to maybe step back. Maybe you could go watch one of my videos on like the trading archetypes video. And although it's not perfect for everybody, I think it's just a general framework of like, you could just type it archetypes and you might find it. But you need to figure out like, who are you as a trader? What is your personality like? Do you like risk? Do you not like risk? Do you like holding trades for 2 minutes? Do you like holding them for 2 years? Do you have a good trading network? Are you doing this alone? do you have a job where you have income and it's padding this so you don't have much pressure, or are you trying to do this so you have all the pressure? Like, I'm not sure where it is. All of those questions you need to start answering, because like then you could be like, okay, I'm a guy who, all right, I'll give you mine for example, right? Like I I like short-term trades. I'm risk averse, so I like very risk defined stuff. I'm more of a fader for that reason, because when I fade, I could kind of determine like, all right, I'm risking this. Here's what I can expect if a reversal occurs. Then I'm really good at holding trades. So if that reversal has follow through, I can hold trades and have pretty asymmetric winners. I have a great trading network, so I'm going to lean on people to help me through my ideas and maybe being a little early. Am I too late? Hey, this is what I'm thinking. I'm vulnerable to people, right? How many times have we had talks where I'm just like, I don't know what I'm doing here. Like, what are your thoughts on this?
Yeah.
Right. And how do I size this? Maybe like I need to answer all of those questions to be like, okay, this is generally who I am. Now, if the person I follow online is the opposite of that, somebody who's like 20, oh, by the way, I have a family, I live in a high tax state, right? I have to consider not blowing up all the time because I don't have fallback plans. I have people who rely on me, right? But if I'm a 24-year-old living in Brickell, Miami, who can fail over and over and over and has, you know, ability to just kind of hustle or do gig work or whatever. I love like that, loves risk, that's deep in like one specific sector, maybe it's crypto or whatever. They should be trading a lot different than me, right? So like, oh, by the way, I forgot to mention this. You're in the equity market, which is the world's biggest, hardest playground, and you're battling the smartest, most capital backed geniuses in the middle of a day, thinking that you have an edge and you don't even have a strategy. Like you don't even like have a way to approach it. What do you think's going to happen? Like, and I'm not being a dick. I'm just being like, hey, like I wouldn't even expect to win. Dude, when I was trading like for 10 years at my firm, do you know how often I would trade NASDAQ futures, NQ? Barely ever. The VIX had to be like above 30. I needed a very specific read on a specific player or an order book read or something, or else I just wouldn't touch it. There's no, dude, it moves around way too much. The liquidity is sparse. Like futures are leveraged. So like you got to give yourself room, but then you're going to have big losers and you're going to lose more than you think. Like I would only go in there when I felt like the game was coming to me. Otherwise, I'd go into other smaller markets. I'd trade a lot of live cattle, lean hogs, soybeans, gold, oil, nat gas, insert whatever, because I had more edge there. So like you got to start thinking about like, I need a strategy. I need to know who I am as a trader. I need a market that fits that. And I need to like learn and learn and learn there before I step foot in like the biggest arena. Hopefully that helps.
Yeah, I think that's great. I think it's a great thing. All right. Wanted to jam through a couple of these really fast. Update on Oracle. Nothing has changed. Still have the same view. Yeah, nothing's changed. On this was good back to another question that we had. Is there a book I can refer to learn the things that I talked about on equities earlier? Probably not. I don't think so. Maybe go to the educational primer section and then spend a lot of time modeling. I think it's just the process of trying to figure out how to find alpha. There are some kind of like papers that you can read. You can go through SSRN papers and look at equity beta, equity dispersion, some basic things. Again, there's papers throughout the entire educational primer section of the Substack. So I would just go through all of those. Like if you go through all of the educational primers on, oh, whoops, it's just there. Stocks, S&P 500, there should be papers down here, I believe. Yeah. Read all these, go through all these trading view indicators, go through like all these things. I mean, I've written primers on every single thing. So you should just go through every single primer and spend time thinking about view indicators, how that go through. All right. Question for flows. Do you measure performance in terms of risk reward, win rate versus average, or do you measure performance in another way? I think about this is there's a section on the educational primer section again that is I map things with risk reward, hit ratio, and frequency. And then, basically understanding where that sits. And basically, if you know the risk reward and the hit ratio, you can know where you're in on the distribution of returns. And then you can say, there's trades that come along sometime where I say, oh, there's a 10 to 1 risk reward, but the hit ratio is maybe it's 100 to 1 risk reward or a 50 to 1 risk reward. But the frequency, this trade only comes along, maybe once a year. And so if I see a trade that's in my view, a 50 to 1 risk reward, 20 to 1 risk reward, some higher risk reward that's like really clear and I have really clear defined risk, then I'll just take that trade every single time. I mean, James, we've talked about that where like you sometimes have moves that take place and you're just like, you know what? I mean, I can see this going either way, but it's just kind of a trade that you take. You just put on your wrist, put on, and you just see what happens,
Yeah, I like those style trades. Just like I'm willing to just kind of take a standard setup and not think too much about it. So,
well, I think that's what you get to a point where, I mean, how, you run so many trades that you see stuff and you're just like, someone's like, well, it could go up and it could go down. And you're just like, yeah, whatever. I mean, like, I'm just going to put on some risks. It seems like a great spot. We'll see what happens, and maybe you're just batting a single, but maybe you get on sides and then it gets more interesting and you say, okay, now I'm on sides and I'm just going to hold this. And then maybe it turns into something way bigger just because you stay on sides for a month or 3 months or 6 months. Right. And you're just going and taking the trades that you need to take. All right, I'm seeing an inflection point. Look at cross asset, realized vol versus implied vol. They're all moderately linked and risk off. I'm thinking the sticky inflation growth fades. I'm not sure what the view is exactly, tidal wave, but the strength in some of these points has shifted a little bit. So for example, let's put this on here. You can see right here, we have equities up and then we have rates down and the dollar down, but equities are up more than the rates and the dollar are down. So you still have you can see the covariance right here, which is the strength between all three. It's in purple right here. It's faded a little bit. So, and then the primary place that is, let me see if I can see attribution. Yeah, I mean, the main weighting in the covariance right now or in the strength of the market is the equity side. And then the dollar and rates are basically in lockstep. And then, you would probably have the dollar has more sensitivity to rates, or is kind of in between rates and equities right now, in my view. So I think that my view is that the inflation we had, everyone thinks in a normal cycle framework where we're going to have like, oh, inflation is going to lead to recession. It maybe, but I don't really think that right now. I think we're still too resilient in all this CapEx. If the CapEx wasn't happening right now, maybe that would be more on the table. I'm not really interested in betting on a recession right now, though. All right. Great comments here. I always love hearing from Tidal Wave. He always has some great ideas in the Substack chat and comment section about, how do you go through journaling, coming up with an idea. He's always really good at being, very consistent in that. All right. Can we talk about the yield curve sensitivity model, how to use it correctly, how to interpret the yield curve? This is actually great because this will connect to where we are right now. And I want to cover this on the yield curve. So if you go into the educational primer section, scroll down. One, if you haven't read this interest rate trading playbook, read it. If you have read it and you haven't put it into Claude Code for your models, put it into Claude Code. You can download it right here. And what you want to think about for this, share this tab. Again, you can download this right now. It's free. All right, so you have the yield curve, which takes the 2s and 10 spread, looks at a 20 look back, and it shows all the regimes. All these regimes, put them into Claude Code and ask them what the regime means, and I'll cover it for you. I'll go over what we're in right now. You'll notice that we were in bull flattening right here, which means the long end is rallying more than the short, or long end rates are falling faster than short end rates. And we've been flattening in the curve right here. Now, people will say, oh, that's because we're moving into a recession or something like that. Not really, especially if equities are rallying at the same time, things like that. But you'll notice that we moved into some bear flattening right here. And then we've kind of been shopping in this range. And then when we really zoom in a bit more, this will be kind of interesting, and I'll connect this back to the oil side of the geopolitical risk that we're seeing right now. So you'll notice that the inflation side of things, you had crude spike up. And then understanding the yield curve connected to that is going to be really key. Does that make sense, James? Or anything you think I should touch on right here?
Yeah, I think one thing, because I'm still working on understanding these yield curve regimes, but one thing, if you guys are out there watching, you have some positions on, screenshot that bottom half right now. You just screenshot that, put it into Claude or whatever you use. Not only say what do these mean, but also say, and like on average, the positions that I'm currently in, which are X, X, and X, which regime do they perform the best in? And like on average, when do they perform the best? And like you could start to learn more about like how your specific trades or assets or portfolio could be, maybe you didn't realize it's actually one of the worst ways you could be positioned into a specific regime. But then you also have to think of like, where is that regime heading, right? Which is something you talk about, because it's always like a dynamic thing, right? Maybe you want to be positioned in a specific sector or whatever in a regime that's not great for it because you think it's exiting into a different regime that is good for it. So I think you can start using that and playing around with that, which I think I'm going to do actually now that I say it.
Yeah. I think that on this chart right here, this is the best thing about AI is you can say like, I don't understand this chart. You can take this, you can connect TradingView to Claude now, and you can just say, tell me what is happening in my TradingView indicator. And how does that, exactly what James is saying. On this idea right here, when I see the curve flatten so much into this crude move, and none of it is, we're not seeing a ton of, bear steepening, so that you can see this bear steepening right here in orange into the crude market, which means long end rates are pricing more upside. When I don't see bear steepening, this goes back to the entire tension of headline versus core CPI. And what I would do is really spend time thinking about, once we have headline feed into core CPI, and if that's really strong, we are going to see bear steepening in the curve, which means the long end rates are going to price what short end rates aren't. So basically, the market's going to realize, oh, we actually need to, price in more long-term growth inflation and long-term inflation. If it doesn't do that, right? So if we start to bear steepen right here, we're bear flattening right now. But if we start to bear steepen, that's when I'm going to be very careful in equities, because when you start bear steepening, when equity evaluations are this high and you have higher inflation expectations running through the system, that's going to begin to create more risk for equities, which is why this goes back to, I look at all of these curve regimes across every single tenor. And I say, oh, well, what's happening across every single tenor right now? Why is it taking place? 2s, 10s, it's bull steepening right now, right? Because we have, rates moving in this manner. And then I want to say, oh, well, how is that happening across, the rate side? How's it happening across inflation swaps and everything else, right? Because I want to look at inflation swaps and say, how are 2s, 30s inflation swaps? They're moving down a little bit right now, which kind of shows that we have a little bit more inflation risk in the system, right? So I'm looking at these across every tenor, and I'm always mapping what's taking place. And if you feel like, oh, this is this seems like a lot. Like, I don't really know how to think through all of this. That's fine. Just take things one step at a time and say, okay, let me start understanding the yield curve indicator. Let me connect it to educational primers. Let me feed it into Claude code. Just be intentional with that. Like, if you get overwhelmed, the worst thing that you can do is just say, I don't want to do this, right? Just find a micro goal and latch onto it and like conquer it, and then keep your macro focus, but just get the micro goals over and over and over. And then you'll eventually get to a spot where you can have an entire dashboard like this. So I think that's going to be a really key thing for understanding the yield curve regime that we're in.
Also, I think like when you're talking about the was it bear steepeners, the area you'd be careful. Like, I think that'd be pretty cool to see in real time, where we get everybody lured in to up only while we're in this current regime. And then once everything looks good, if you start to see the signals, as we're going through these live streams, as we're getting the signals on your dashboard, and you're starting to see those caution lights, it'll be interesting to feel what the market will feel like in that up only phase, while everything is starting to roll over regime wise on the back end, and how that will play out. You know what I mean? That's
Totally.
like a great, like, I hope it happens purely so that we could experience that and be able to chuck it in the back of our history, in our arsenal. Because the more reps you get of like a regime shift and learning how you were positioned during that shift and how it affected you, will help you moving forward.
Yeah, absolutely. I totally agree. I think a lot of the times why I'm able to get in front of some regimes is because I understand the yield curve really well. I mean, very simple. Like, I spend a lot of time looking at the yield curve, and it against other global yield curves and how it impacts FX and equities and equity rotations and things like that. And I would encourage you guys. This right here, great question. I mean, if you guys are here in the live stream in the chat, I mean, questions are free call options, right? Like, it literally costs you nothing to ask a question. And when you're saying, oh, how do you talk? This is a great question, because it's not about like, oh, should I, buy a call here or short a call here? What should I do? I need to make some money right now. It's, hey, can you teach me how to understand this thing so I can grow and learn and build up my strategy more? I just think that's really key. So I think, questions are free call options, and you should just always just pick them up when you can. It's a free lottery ticket. All right. Couple other questions here. Across TradFi, what are the main drivers of short-term price discovery in futures, spot, and things like that? Great question. You should go exactly to this educational primer here on intraday trading, intraday liquidity provision. Read everything in there, and you will know the answer to that, because I wrote an entire primer on that exact thing. Great question. All right. I'm betting on the semi-secular cycle, 10-year time horizon, aggressive barbell, 50% in shares of global semiconductor ETF, 50% conservative, non-correlated ETF in Europe, globally diversified. Do you think my strategy is good? Well, here is what I would say about that. Number one is 10-year time horizon is a long time, right? And so I don't really believe in like secular cycles, really, because you can have a lot of stuff happen in the interim. And if you're kind of just saying like, oh, I'm just going to bet on this for the next 10 years, well, then just bet on it and then just basically go do something else. Like, you don't really need to do anything else if that's your aggressive strategy or something like that. But what I would say is that I think there are still a ton of upside in the semi space because of all of the, I mean, that's why I'm still bullish NVIDIA. I still think it's going to, move up a ton and move to all-time highs, because there is so much upside in the amount of chips that need to get produced for all the robotics that are coming at us through the system right now. So I like that idea, but the question is, when does that get priced, and how do we think about that? And I think, James has actually been working on a lot of ideas connected to the semi space, and maybe James, you can kind of cover some of these ideas as it relates to one of the stocks you've been looking at.
Yeah, and I don't claim to know too much about this space. I'm gonna get more into it. I've been doing some Claude work today, having it. I basically so Qualcomm. All right, guys, like you probably haven't heard the name Qualcomm in a while. It's right in there. It's right in the mix of the memory AI memory play, and I know I live in San Diego, which is the home of Qualcomm, and I know some people who work there. And I talked to them about this, and their stock gets pummeled, and uh, nobody really regards it. But it was an interesting morning where Intel had like the big blowout earnings yesterday, and Nvidia is making a push towards all-time highs, and AMD is near all-time highs, and then you got old Qualcomm, which has Snapdragon, and like if you look into it a little bit.
Your screen, James.
Oh, sorry. Yeah, let me do that.
Or I can pull it up as well. I think it'd be helpful for you to
well,
kind of talk
about. I'll just share what Claude gave to me, and I'm working on this, guys. So just take this as like a first run here. But if you haven't done this, like this is a good example of something you could do with Claude very easily. Okay, so I basically just said like, all right, I'm interested in Qualcomm. I want you to give me a kind of in-depth bull thesis on Qualcomm in regards to like an AI play with its competitors, and give me all the talking points that you think are most interesting, right? So, and then 5 minutes later we have this, right? And I haven't even had time to read through it all because we hopped on stream. But basically, I could just run through it a little bit, right? Here, price of the stock, forward PE, buyback is 15% of the market cap. Which, by the way, in the background, I was just asking, what's that compared to their competitors like Nvidia and Intel and all them? Way higher. Nvidia's buyback is like 60 billion or something, but it's like 2%, right? So that's just an interesting thing to note. It's a cash machine. It's had a huge drawdown, right? Cheapest in the game here. You compare it to like Intel, AMD, Nvidia when it comes to like the forward PE, right? It's got all sorts of like connections and networks and moats that have been around for a long time. A CEO that's my buddies who work there say their CEO is a savage. His name's Santiago Amon or something. I'm going to have to go look a little bit more into him too, but that's another thing you could just throw into Claude. Tell me about the CEO. Tell me why he's potentially good or bad for this company, right? By the way, they have an earnings coming out on the 29th. And if you think that there's going to be kind of this run or maybe whatever, you could go into the earnings with a position, not in a position, whatever. And it'll even put like little catalysts. The Q2 earnings print 5 days out. The CEO confirmed that there's advanced discussions with a leading hyperscaler. If they reveal that name, that could be a catalyst. Snapdragon ecosystem scaling, inference chips, $20 billion buyback execution. Checks a lot of asymmetry boxes, right? So a lot of things are already priced in, and not a lot of upside catalysts are, right? So then you have a bear case down here, which you could go read, fade the CEO, a memory shortage, whatever. All right, so now I'm going to pull up. You can stop that screen, and I'm going to just share the chart. All right, so share screen, the chart. There we go. So let's go look at the Qualcomm chart. All right, this is kind of how I do things, guys. I like take a broader aspect, like what have we been talking about on Flows' live stream? Where do I think we are? Where do I think the markets are headed? Okay, now let's go dig into some interesting things that anecdotally I might have a little bit of edge in or something. Then let's go to the chart and look, hey, is there an interesting charting opportunity here, right? Like when I look at this, I'm thinking to myself, okay, like we had a channel, we broke down a little bit when the software was getting murked, right? When IGV was getting down, the max drawdowns, Nvidia was down, blah blah blah. Now we've kind of reclaimed that. We're at the 200-week moving average. We've re-entered this, and we have earnings coming up. Now, when I think about all of that, do I necessarily have to be right on the thesis to take a bet? Nah. But do I find asymmetry here? Do I find something nobody's talking about where vol is not expanded? Going back to Alfie's comment, where vol isn't expanded yet, where the story can build on itself. That's interesting to me. So I'm going to keep digging into this. Maybe it's something we can cover in the next week or two as we move forward, especially after the earnings, right? But like, to me, this is trading. You know what I mean? That's trading. So I don't know. It's just something fun to think about. What are your initial thoughts when you hear something like that?
Yeah, I think it's
you're like, nah, it sucks.
It's something I want to dig into a little bit more, and I think it's interesting because this goes back to, there's always dispersion in equity sectors based on fundamentals, right? So the entire sector is going to move up and down, but why are some stocks outperforming others? And if you can know the why behind that, and then you can say, oh, well, yeah, it's because of this, and that's probably not going to last for very long, right? Like, I think the Oracle thesis I have, like the work I've done there, it's kind of been, oh, well, they're doing all this CapEx and they're supposed to have all this other stuff coming online. So there's actually a reason why they're down, and that reason isn't going to last forever. So that's why I look at stuff and I say, okay, well, why is it underperformed? Is that reason why it underperformed going to persist? If it's not, okay, what's the time horizon that it's likely to, stop its downward pressure? Okay, this time horizon is probably in the next 6 months. The market is already probably going to front run that in the next 5 or 4 months. So how do I begin, mapping those changes? And I think that's a great way to kind of begin thinking about it. And then exactly what you're doing of, let me, if you have Qualcomm in the MFRA indicator, do you have, go into there, the MFRA and the settings of it?
Settings.
It's the little button. Yeah. So put the Qualcomm stock there, and then let me.
Ooh, interesting. So I have to switch these two, right?
Yeah. So you want to keep XLK, I think, and then I think IGV, that should be, I believe. Let me double check, because I'm pretty sure it's yeah, put SMH there.
Yeah. Okay.
And those are all correct. So that's correct. You have the market one, you have the subsector, which is SMH, and then you have the sector, which is tech, and then you have the stock symbol, and then you can kind of click OK.
And SPY is right.
Yes. Yep. Because it's in the S&P 500. And now you can kind of see, well, how much of it has been based on fundamentals, which is very interesting here, right? So like, you have in the left-hand side, this is the daily chart. All of that purple that's going down right there has been fundamental selling pressure, which just tells me if you can figure out why that selling pressure took place over the last year. So you can begin to say like, hey, you can connect this to Claude Code and say, see my attribution analysis. Why did the fundamental selling pressure take place? Does it have persistence? How should I think about the fundamentals relative to that? And then connect that to your Claude Code output that you have in that tab. So I would just take this.
Yeah, I just did it. I'm doing it right now.
Yeah.
I screenshotted it, circled it, and put it in there and said, why did this fundamental selling pressure occur? And then after I'm done with that, I can say, all right, I want you to remake the output. So I already have like it redoing the output to compare buyback pressure to competitors to add in there, but also this, because I want to refine it to where it could just stack and stack and stack on a thesis or negate it, right?
Yeah. As you go through it, I'll
it
go for it.
says like, yeah, it says here's what was actually stacking on the tape during that window in rough order of weight. The Q1 2026 print itself, the memory bomb, they called it the memory bomb. They beat on the quarter but guided Q2 below the street. Amon, the CEO, went on a call and basically said the whole fiscal year of 2026 handset number, so like all their chips into phones and stuff, will be determined by memory availability. DRAM manufacturers are diverting capacity to AI data centers, which starves smartphone OEMs. Stock dropped 10% in the extended session. So that started the kickoff of the purple cluster for fundamentals. So there was like a concern of all the memory was being put towards data center use rather than smartphone capability, which is a big part of their business. So that makes sense.
Yeah, so I would just try to think about is that have persistence, or is the returns from all of the data center build out going to begin to show potential, right? Because if you zoom in, what's on the day today, what's the driver? I think it's a fundamental one, right? Yeah, it's purple.
Yeah.
Yeah, so that's super positive, I would say, right? Because it's your fundamental driver beginning to reverse and add positive price action, which shows that it's not just the market's bidding, or it's not just tech is bidding, but it's actually the fundamentals as well.
Right.
So
and then you could also, there was also the indicator you had, right, of like how to compare it to outperformance. Like you could compare it to NVIDIA or whatever, or Intel, and you could do like which one is outperforming which.
Yep.
Yeah.
So if you go
more the SMH maybe.
Go to this tab, download this one, the cross-sectional momentum indicator. You can just take this one right. Oops.
You probably got to put me off.
If you go right here, go to this first model in the trading view section, and then it'll pull up this, make a copy of this chart. So click right here, copy it. You cannot copy and paste these. You have to copy this chart, and then you can copy and paste them. It always works. There is not an issue with the indicator. The issue is with the user. You have to copy the chart. Then take this indicator and you put your stock in there and say, when is it outperforming the index and all these other things. Once that happens, then that tells you a signal. Like relative performance sends you a signal. If NVIDIA is outperforming the index, why do you think it's happening? It's happening because it's adding more value than the index itself. So it's not, this is not rocket science, right? If you're running faster in a race than someone else, it's because you're better than that person. I think this is, so think about that, like what, the race itself, if everyone's running, you all might get a great time, but that doesn't mean you win, right? You need to think about, okay, well, where is everyone placed? What's the environment? Why is this taking place? Who should be winning? Who isn't winning? All this stuff. And yeah, I guess you could say if you're having a race and one person's winning and losing, the betting market on that race is the options market on an equity, basically. I don't know if that was too much down the rabbit hole, but that's how I think about it. I think this is a great kind of thought process to go through, especially on this indicator, because I think it's perfect. Perfect example.
Yeah, like this is just like the new way that we retail participants can like really dive into this stuff like we never could before. And how cool is that? You got your stuff, you got Claude just ready to take everything and help you. Like you could have edge. Like this is edge.
100%. Cool. Yeah. I'm gonna jam through a couple more of these questions. Just so we can go through them really fast. Do you usually hedge big positions? If yes, what sort of hedge do you think is best fit for Oracle? This comes down to, what are you hedging? Are you hedging market risk, fundamental risk, whatever it is? Where did that go? And so, sorry, I'm trying to get my screen back up. So all of this comes back down to what are you hedging exactly, right? So are you hedging sector risk, market risk, or a tax liability, or what are you hedging? And so just figure out what that is, figure out your hedge ratio. So if you're going to, if you own, 100 shares of the stock, then you're going to buy one put or one call or whatever it might be to hedge against a certain move. Same things for futures. You calculate the rolling beta or rolling correlation of whatever it is. Like that's what happens. That's what all these long short equity funds do, right? They have a macro risk or macro event, and they come into the market. They sell a ton of ES futures, and they say, well, how much of a correlation does our book have to the equity market? We're going through FOMC. Get me market neutral. Sell a bunch of ES. Now unwind it after the event, and that's how they hedge their equity risk. So there's a lot of different ways to do it. It's going to depend on that. So that's what I would say. How do you connect the yield curve with FX? Start with just nominal rate differentials, and then from there, underneath that as a subcategory, look at yield curve differentials. All right. What's the ticker for inflation swaps? To my knowledge, they're only on Bloomberg. You can look at the RINF ETF or the TIPS ETF. And you can also look at break-evens, which are not the same as inflation swaps, but it's the next best thing. 10-year break-evens. Watch those. And ticker's up in the upper left-hand corner right there. All right. This is a great idea. Alfie is a great example of someone who's like learning a ton. It's easy to say, but honestly, if you break down the concepts one by one, just focusing on understanding them, eventually just connects. I don't know how, but trust me, it really does. Learn everything about rates. I was just like, I don't know, man, what that even means. So I just went one by one and started making subconscious connections to equities, FX, and eventually still do it by topics now. A lot of things I struggle to understand. So I just learned one by one. And in like 2 months, these concepts will connect. This is 100% true. Just go through things one by one. I mean, I still do this today with new things I'm trying to learn. I have like a massive list of books I need to read, articles, reports, models I need to build, and I just jam through them one by one. If you're saying, well, that might take 3 months or 6 months, nothing exceptional takes a short period of time. So just lock in and do it, or just don't expect an exceptional outcome. All right. Let's see. How to use the CS momentum indicator and correlation model on TradingView while trading single name equities. What I would do is find the equities that probably have the most upside or outperforming the market the most, and then buying those and selling the laggards. If you're not looking at fundamentals at all, you're just probably betting momentum and which ones are outperforming. All right. Let's see. All right, another great question here. What specific signals or conditions would invalidate your current bullish view and make you flip bearish? To be clear, and I think this goes for James and myself, if the signals flip, I will short this market. Like, I have no problem shorting the equity market or shorting any market in the world if I think it's going to go down. So I am not one of these people who thinks like, oh, well, man, like, what, just has all these views that are not connected to reality. At the end of the day, if you think the market's going down and it's going to go down a lot and the risk reward is there, you short the market. Like, that's very straightforward. It doesn't happen a lot, so you should be aware of that. So what specific signals or conditions? I've laid all of this out in the credit cycle playbooks on the website. So if you go to the website, go to Decoding the Warsh Testimony, scroll down. Whoops, not in that one. Let's see if it's in this one. Yeah. Credit cycle playbook, the melt up trigger, the largest bet in the credit cycle, cross-border flows. I've laid out right here all of the progression, scenario analysis, and breakdown for how to think about the credit cycle. That was published on April 21st. So go to April 21st, scroll down, go to these, read through all these. What I would say, broadly speaking, is that the current melt up is being driven by macro liquidity. And two things are going to stop that likely. One of three things, actually. The lowest probability is a recession. I don't think that's going to happen, where it begins to drag down earnings and change that. I don't think that's happening, but it's possible. Number two is inflation becomes an issue and long end rates blow out and pull equities down like 2022. That's another issue if that happens. That's one of the biggest risks that could stop this bull market and credit cycle. The other one, which I think is the highest probability and is my base case, but is not happening right now, is basically a rerun of the, not driven by tariffs, but driven by a trade rebalance. And it would be the dollar selling off at the same time as equities because cross-border flows exit the United States due to some type of connection where the US pushes back on China trade and makes China really rebalance a lot of its exports. I think that could be the thing that shifts everything. I think that the private credit market or all these other things that people are coming up with were why, the equity index was down previously. I think that's all. I mean, maybe I think there might be issues in private credit, but at the end of the day, my view is that it comes down to what's driven this market up. But if you know what's driven the market up, what's going to stop it? And right now, that's liquidity, which is why understanding the yield curve and rates and everything else is so important, which I'll be laying out more this weekend in a report. It is Friday. I forget this, James. It's Friday. I'll be laying this out on a report this weekend.
Do you throw up that last comment there? The Oracle is destroying me. I want to reiterate here that one of the things is like, if you are deciding to pop around and listen to other people and kind of taking conviction from others, comments like this will come. This has been something that's talked about for a while. You have to consider where you're getting in. Do you have the conviction to hold for a period of time to allow the broader thesis to play out, right? Just because somebody mentions Oracle does not mean it has to go up after it's gone up, whatever it is from the lows here, 30% or something, right? So did you buy in at what, 185 because it finally hit your radar? Well, these are just like lessons to think about, I think, of like timing and taking conviction from places and time horizons and stuff like that. Because if you bought at 185, you probably bought with the idea that it could go back down, but this is something you're thinking about for 6 to 12 months as we've been talking about it. So if it's destroying you here, being down 3% or 4% or 7% or whatever, while other things are going up, you're probably in for a little bit of a rough 6 to 12 months here. And it seems like you're probably going to make an emotionally driven reactive decision based on price movement alone. So we're trying to work on that, right? Maybe just take a look inward and think about, is this a position you really want? Why did you do it? How long are you okay with holding this? What portion of your portfolio does it make sense for you? Do you believe in the sector? Like all that stuff. And maybe you don't mean that. Maybe you're just trolling or whatever, but I think it's important to review.
Yeah, and I think it's good to, if you went through all the research on the Substack about my view, and I've said this, James has said this, if you expect to do incredibly well by doom scrolling on Twitter, seeing some comments and clicking around in markets, then you have, grossly overestimated yourself. And you really need to think about what exactly you're trying to accomplish, because your current plan isn't going to work. On Oracle, here's the entire report that I laid out. I actually did, I did an entire slide deck on Oracle that you can go through yourself. Let's see how long this slide deck is. What would you guess? Yeah, we have a 17-page slide deck going over the entire thesis of Oracle. If you haven't been through that, then you probably don't even know why I'm long, right? You just think, oh, it's down a little bit. Maybe I should get long, right? Not a great strategy, right? Because then you don't know what happens if I just, something happens in my life my account gets hacked. I don't wake up tomorrow morning, but like, what are you going to do if I don't show up on Twitter, right? I'm going to show up every single day that I'm here. But, you know, what happens if my Twitter account just gets deleted and hacked, and my Substack gets deleted and hacked, or I have an entire thing that's I'm down for 3 weeks and I don't have any technology? I mean, you know, this goes back to understand the thesis, which is here's a thesis and then here's the risk reward. I have my stops at 109, not, you know, wherever, you know, whoever's feeling right now, max pain. So I think that's, you know, really, really key to remember, and, you know, really important to take accountability in that realm. And on the top of all that, I could be totally wrong about Oracle, right? So you have to take that into account too. How much am I willing to lose if I'm wrong on this view as well? So I think that's really key as well. On the multi-factor attribution, it can be, I said this earlier, you need to get the difference between an OLS and a PCA indicator and know how to calculate residual. If you don't know what that means, ask Claude Code. It'll build both for you. You can see the trade-offs. Oracle runs negative free cash flow. They have recently because of their CapEx. But if they stopped CapEx, they would be massively cash flow positive. And all that CapEx, once it begins to pay, is going to bring in a massive amount of cash flow back into them. So I think that's an important qualification as well. James,
just,
as we're
just to add on one last point, I think if you listen to what you're saying and you've actually gone through the slide deck and you actually understand the thesis, and you know, if you're saying Oracle is destroying me, you're probably sized up too much near the highs. You should like imagine the comment saying, "Thank God Oracle is dipping here. I now get to fulfill my position on this thesis that I have a lot of conviction in." Right? Like that's much different than buying the highs, not understanding the thesis, short-term time horizon, and saying it's destroying me. There's, you know, there's two sides to the coin here.
Yeah, totally agree. It's kind of funny because the funny part is I've heard both sides where people say like, "Oh, I'm waiting for the pullback," and sometimes I just think like, "I don't know if there's going to be a pullback, man." You know, like it's kind of funny. Like that's the entire thing I've had with PER is I've had people tell me like, "Oh, I want to be long PER because I've been laying it out." Yeah, this is understanding the trade-offs of a position, right? This is, if you're a trader, this is what you think about all the time. I got long PER like in this range right here, like sub 350. If you go back on the report, you can go back to paid subscribers and see everything where I laid it out. You know, we're up 100%. So many times I've had people, you know, we'll get down to, you know, we'll get right here or, you know, something like that, you know, or we'll get, you know, they're saying, "Oh, you know what? I'm waiting for a dip back down to $4. Well, okay. If we dip back down to $4, I mean, that would be an amazing entry, but are we going to dip back down to $4? And maybe you're just saying like, "Oh, I'm just going to use discipline." But a lot of times that's, you know, do you even know why it would dip? Do you know how far it would dip? Like, do you know the risk reward of it dipping or anything related to that? Or are you just afraid to buy a position and size it a little bit smaller and just say, "I'm just going to size it a little bit smaller, and if a dip does come, I'll add a little bit"? And I think a lot of people, they don't like, you know, I have no problem buying a high if I think it's going to keep going, right? But I need to have some edge into thinking it's going to continue to go. And if I think there's going to be a dip, then I'll wait for a dip. But if I don't think there's going to be a dip, why would I wait for a dip? Right? It just goes back to, how are you thinking through these scenarios? Are they based out of your own insecurity and fear and just saying, "I don't want to take action"? Or, you know, it just goes back to panic or procrastination, right? Are you going to panic trade into something? Or are you just going to say, "Let me just procrastinate and wait because I don't want to be wrong, so let me just do that"? Instead of, you know, for James and I talk about this all the time. If we see something, you say, "Oh, okay, well, we're at this spot. It's okay. Let me just put on a little risk. And then if we go here, I'll put on some more. And if we don't, that's great. I'll just, you know, I'm on sides. Maybe it's a little bit less than I would like to, but let me moderate my exposure based on that." So I think that's how I'm thinking about that. You know, curious if you have any additional thoughts or anything to add to that, James.
Just on the procrastination thing, this quote that I heard last week has just been like living rent free in my head. As a guy who has procrastinated a lot in life and not taken action in certain times and things. This is what it says. Procrastination is the phobia of discovering you're not who you really think you are, so you don't start. And not starting preserves that fantasy. The fantasy is comfortable, but the fantasy is killing you. I think that's pretty good. So
That's good.
procrastination is the phobia of discovering that you're not who you think you are. Oof. Woo. That's a good one for us procrastinators, because that I don't know if you actually associate with that. that's
think
not your weakness.
Yeah, I mean, I think I have a tendency to. I think this comes down to how wired you are as an individual, right? Like we talked about this. Like I think I'm probably more prone to panicking or FOMOing to something instead of procrastinating, but that can get me into just as much trouble. Rich Davini in his book on attributes talks about patience and impatience, and not as a positive or negative, but just as some people just move more aggressively and faster through life, and some people move slower, and those have their trade-offs in both ways. It's not about, oh, you should be patient here and you be patient, or you should be aggressive here and you're aggressive. Well, yes, that's true. You want to match your actions to a situation where you need to be patient or aggressive, but it's more about what disposition do you have? Because for me, I'm more likely to, as soon as I see something, I just act right away. And I have a lot of forceful, aggressive momentum in my life. But if I'm not thinking through that and slowing down a little bit and saying like, oh, how should I size this? How should I think about this? Should I go all in on this, or am I just being a little, am I extrapolating things a little bit too fast? Right? Like I have a tendency just to take a ton of risk just because that's who I am. Right. And I need to moderate that a little bit, where I would kind of probably guess it's the opposite for you, James, maybe relative to me at least, right?
Yeah. But I think that's why it's good that we do this together, right? Because a lot of people are either on your side, my side, or somewhere in between. So I think it brings really good perspectives, right? It's like the benefit of not being in echo chamber groups, right? It's just like you just all work each other into a corner.
Totally. Couple more questions here before we kind of wrap up, guys. If you have any extra questions, put them in the chat before we're kind of going to wrap up for the day. But again, everything is laid out on capitalflowsresearch.com. If you're not there and going through all of the educational primers, I mean, everything's here, guys. Like everything's here. In the Monday write-up, you mentioned buying calls on software. I strongly believe the best place to buy calls for the next 2 weeks is the software names. So I don't typically build a position over the next 2 weeks with leaps. My view is that so I don't really buy weekly or like 2-week calls or stuff like that. I'll typically buy because of the theta decay and stuff like that. I would rather just take spot risk depending on how my risk budgeting and how much basically capital I have available to margin. But basically what I would say about this is I will typically try to find either if I can do a call spread, or I will try to buy calls and then roll them every 30 to between 30 days and 60 days, and kind of roll those so that I am on the other side of the exponential theta decay. Because like if you basically buy any options shorter dated than 30 days, the theta decay basically just increases exponentially. Basically, you start losing a ton of money on that side because there's a lot more theta decay, a lot more, but there's also a lot more gamma, right? Which is why people buy a lot of 0DTE options and stuff like that. That doesn't make sense. That's fine. I'm sure whoever asked that question was definitely asking, or that made sense to them. Given the current geopolitical risks, what would force the Fed to hike instead of holding? Very simple. Number one, equity market probably needs to remain resilient. And then number two is we need to see headline CPI transmit into core and transmit pretty aggressively. So for example, right here, we have headline CPI over the last 5 years. Inflationary market right here. If we come down, 2% is the red line right here. we ticked up recently. And if the same speed, so what just happened, if we escalate further and make new highs in oil, then over the next, into the end of the year, we're probably going to have this path for oil. I don't think that's going to happen, but because I don't think we're going to escalate. I don't think we're going to have new highs in oil. It wouldn't be something I bet on. If we do, then yeah, you're probably going to want to sidestep a lot of equity risk because it could feed into core. And this comes down to core right now is diverging from headline. And you can see that the most recent print, here's the most recent print on month-over-month change in core, has not really moved a ton, right? So for example, if we look at, let's go to 2-year, this. Actually, that'll take a while to explain. Let's not go over that. For core CPI, we haven't accelerated to cause an upward trajectory yet. So it still needs to feed into core, and we still need to see how much of it transmits into there. If core begins to rise, that's when we have issues, because core CPI rising in 2021 was the main issue. If you actually look, the bottom in equities was when core topped, not when headline topped, because core is typically when you have a lot more demand side inflation as opposed to the headline section, where you can see, here's PPI, and you can see that we're probably going to move up in PPI a bit more because it has more connection to trade, energy, transportation. PPI is right here. If we look at, these are CPI inflation swaps, but you can see that we're probably going to have a bit of a divergence and have PPI run a little bit hot, but then not feed into core yet. So if we look at core PPI, we have a little bit less of an aggressive upward move, and then X, it's trade and transportation and things like that. You can see we pumped up a little bit, but we're still, the inflation market is still kind of projecting lower inflation. And as long as CPI doesn't make a new high, that's probably going to take place. The one thing I would say is that going back to bonds and interest rates, I'm neutral to 10-year right now. I don't want to be long or short, because if we transmit into core CPI, it is possible for us to kind of make a little move up here and then back down, or chop around in this range a little bit, which is why I'm just neutral. I wouldn't be surprised to see us move down, but just because of where we're at with growth. But overall, I'm just a lot less. I don't think we'll make new highs in the 2-year, because I don't think the Fed is going to try to hike. So I think, we're just going to move back down. But, overall, I'm more neutral to long end. I'd rather be long stocks than bonds. And I think gold is probably a much better play than being long bonds here, because I think the dollar is moving lower. And if bonds don't blow out to the upside, if bonds blow out to the upside, we probably have a pullback in gold back down to this level. But if it doesn't, which is kind of my base case because I'm more neutral and I'd rather be long gold, short bonds, gold could just make a new high real fast in short order. Silver, same story. Copper's already ticking up. So I think that's really interesting. My view is all metals are going to start making new highs soon. So that's my view on where we're at with everything. James, anything to add to that, or any nuance you would provide for it?
No, I was making a trade, so I was checked out for that segment. Sorry, there was a trade happening, guys. This is what you get, This is the fucking shit right here,
I give you books to read and you chew on the cover.
That's right. They're not picture books. So.
What are we running a trade in? What are you thinking?
It is in a crude calendar.
Okay.
So it's an order book thing. So it's a little
cool.
Proprietary information, guys. Sorry, we can't provide everything.
All right. Well, we've covered a lot in the live stream. I'll be covering more on the Substack. Appreciate everyone joining. James, what can we look forward to next week with everything that we're doing?
Well, I am going to be marching over to the Bitcoin conference to support the digital store of value that most of you guys out there probably aren't supporting right now. And for one, I don't appreciate that. For two, I'll be over there trying to make the amends, and by the end of next week, maybe you'll all be urging to buy some Bitcoin yourself. So I'll be back probably Thursday or something for streams. Other than that, make sure you tune into Flo's. He's going to be doing this every single day, and hopefully moving forward here, we might turn this into something special. So we'll see.
Love it. Love it. All right. Well, if you're at Bitcoin Vegas, DM James, and he'll buy you a drink at the bar on Capital Flows.
That's right. Yeah, you got. Have you sent my business credit card to me yet?
I need to send you a business credit card, and we'll give you a corporate card on the credit account.
Yeah, we need to have an agreement. Yeah, if somebody finds me there,
if someone in the live stream today is at Bitcoin Vegas and they DM James, he will buy you a drink on me.
There we go. I am the middleman. I'm the liquid broker. I am a highly liquid broker.
You're just the transaction layer.
That's right.
What a
Is that all we are? Is our friendship transactional? I guess.
But that's all it is. You're just a transaction layer. It's like someone saying like, what was that? I think you sent me a tweet where if you want to insult someone, you're just like, oh, that's a really cloudable skill. Cool, man.
That's pretty good.
So, all right, everyone. Well, everything is laid out at capitalflowsresearch.com. Everything is laid out on James's YouTube channel. Should be going through all those. If you have this weekend, spend time investing, right? Just think about it. Most people are not going to do that. Most people on this stream are probably not going to do that. Just lay aside a little bit of time to be able to invest and invest in yourself. So that's what I would encourage you to do. That's what I'll be doing. I'll be around on the weekend. You can always shoot me a DM on Twitter. I try to be around and go through all the educational primers on the Substack. I'll be having more next week and this weekend for paid subscribers. And with that, we will catch you guys soon.